started. Hello, everyone. Welcome to All In on Real Estate. I'm your host, Aaron Goins. I started this meetup because when I was in the military, no one in my circles was talking about or want to get into real estate. And a lot of times, people in the military, we talk about debt, they talk about finances, but nothing about real estate. So I want to start a meetup where people can learn about real estate, all different issues of real estate, and build generational wealth for them and their families. So I'm very, very excited for our guest speaker today, Mr. Mike Morawski. How you doing, sir? It's good to see you. And please introduce yourself, everybody.
Yeah, sure. Thanks, Aaron. I'm Mike Morawski. I have a company in Chicago called My Core Intentions. I'm in the coaching and training space. I work with multifamily real estate investors, teaching them how to grow their business, but live a balanced lifestyle and hopefully not make the mistakes that I made along the way. And I also syndicate real estate deals, and we raise private capital and place it in multifamily properties.
Awesome, 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 awesome. So, every guest speaker, I love to just start off. I always want to ask this question: why did you get into real estate? And just take it from there. Why did you want to get into real estate, and what was your intention with it?
Yeah, so I didn't decide to go into real estate because I woke up one morning and said I'm going into real estate. It's kind of funny. I don't come from a family background that's entrepreneurial. I don't come from a family background that was real estate. I think I think early on I got attracted to real estate, and I tell this story because I was 8 years old. My family was on vacation. We're at some resort. I'm sitting on the side of a swimming pool with my dad, and he is, I'm asking him about the rooms around the pool, and he's explaining to me in his infinite wisdom that people come there, they stay there, and they pay the owner money. And at that moment, at 8 years old, I knew I wanted to be the owner collecting the money, right? And I knew nothing else about it. And along the way, I didn't know anything about it. Fast forward, I was in the construction business in Chicago for a number of years. And I actually started out in the swimming pool business and putting in-ground swimming pools and doing service work. And if anybody lives in the Midwest, they know that in the winter time to be in the swimming pool business in Chicago isn't a good business to be in. So I'd hire these guys and have to hire new guys in the spring every year, and it was costing me a lot of money. So I decided I would go into try to figure something out that would keep guys busy all year long. So I went and started doing kitchen and bath remodeling and building room additions, and I grew this company kind of, pretty quickly. That I had 25 guys working for me and a bunch of equipment and trucks on the street, and I was still doing all the scheduling, all the buying, all the marketing, all the selling, all the bookkeeping, and banging nails in the field. Woke up one morning, looked at my wife, and I said, I'm done. I can't do this anymore. I was burnt out. I was fortunate somebody was knocking on my door trying to buy the company. And so I sold the company and took a year off. And during that year, didn't know what I was going to do, but my wife and I at the time, we house hacked a couple of houses. Now, this is long before it was sexy or the thing to do. So it was long before it's what people were doing. And now everybody, it seems like that's how they get into their first house or first investment is they house hack. Well, we house hacked these couple houses, and we were living in them. And I remember her screaming at me about nails on the floor and stuff like that. It was crazy. But I met a real estate agent along the way. And as a result of meeting him, I thought, man, this seems like a decent business to go into. So I went and talked to Todd, and I asked him, what he thought about me going into real estate. And he really encouraged me. He said, I think you'll be great at it. And so I said, well, could I shadow you? And he said, no. He goes, I'll do better than that. I'm going to make you a cassette tape. And that's what he did. He made me a cassette tape that I burned out. I listened to it over and over and over again, and went into the real estate business in April that year. And in 9 months, I sold 78 houses and was Remax Rookie of the Year that year. I went on to build a team selling 125 homes a year. all listings. I gave all my buyers away, and I did that for about 10 or 12 years consecutively. That's how I got in real estate.
Wow, that's cool right there. That's cool right there. So I think the music might be in the background for Mike.
I'll go, let me turn it down. Sorry about that.
Oh, no problem, no problem, no
A
problem.
really good microphone.
That's good. That's awesome right there. That's awesome. That's good. You see, you're getting congrats, Mr. International right there. Right, saying that's great. Cinto said, thank you. So, you got into real estate, you was doing house hacking, you was before your time, and that's awesome right there. So what was the next step for you? You sold your company. What was the next step?
Yeah, great question. So I sold my company, went into real estate. I was selling hundreds of houses a year, and this was long before it was kind of a normal thing. Now I know a ton of people that sell 200, 300 houses a year, and it's just kind of a way of doing business today. But in 2005, I saw the market starting to shift, and I've always been the kind of guy that I never want to have to fire anybody. I don't want to give anybody bad news or tell anybody anything's wrong. I kind of always want to be the hero and fix things. So in 2005, I said, well, I'm going to have to go do something different. I had 7 people working for me, and the market was shifting. It was slowing down, and I didn't know really what was going to happen. So I decided to go in the apartment business. And here again, this isn't one of those things that I woke up one morning, decided to go in the apartment business. When I was in the contracting business, I did a lot of work for a couple of apartment syndicators here in Chicago. And they're pretty big companies. Matter of fact, one of them is Inland Real Estate. I don't know if anybody's heard of them. Inland is one of the largest REITs in the world today. They started out in Chicago, 4 high school teachers went out, they bought their first 4-unit apartment building, raised a little bit of money for it, and today they're in 80 countries and in every asset class across the board. But I did a lot of work for them as a contractor, worked in their apartments, and I understood the model. And here's what I understood was that you find a great real estate deal and you marry it with private equity. So you go out and you find people who want to invest in that. You marry it together, you stay in the middle, and everybody makes money. I've always believed, I heard Jim Rohn say years ago that success leaves clues. And so that's how I went and talked to that real estate agent to teach me what to do in that business. I studied the inland model and the syndication model and knew that if I found a good real estate deal, that I could go and raise capital. So in 2005, I decided to go in the apartment business, and I go and I find my first building. It's an 11-unit apartment building. Now remember, I've been in residential all these years. I don't know anything about the apartment business. I don't know how to underwrite. I don't have a fancy tool. I don't have any spreadsheets. I don't know how to do due diligence. I'm listening to everybody and taking everybody's word and everybody's advice. And I say, okay, so I put this deal under contract, and then all of a sudden I realize I got to go raise some equity. How am I going to do that? Well, I put a little ad in the newspaper, a classified ad in the local newspaper. I spent $45 for 3 lines. It ran for 4 days. All it said was real estate investors wanted. Over the next 7 months, I raised $600,000 and, funded a couple of deals along the way as a result of it. But my phone rang off the hook, and it was pure excitement at that point. I didn't know anything. It was just my excitement that this is what we were going to do. Here was the vision. I'm a visionary, and I knew that I would get down the road and we were going to buy 1,000 units. The goal was we're going to buy 1,000 units in the next 5 years. I had no idea how big my business was going to grow and how fast. So I did that first deal in 2005, 11 units, and I realized very quickly that I didn't know anything. Here I am with what I thought was going to be a good deal because the seller said, oh, you'll be able to buy this, do some repairs, put new tenants in there, you'll be able to raise the rents. And none of that came true. And so I bought this bag of bricks and quickly became a don't wanter and couldn't get out of it fast enough to get rid of it. But we wound up making money on that deal. But here's what I learned along the way is I after I bought that deal, I went to my broker and I said, hey, listen, Ryan, we need to come up with a buying strategy. I can't do this. And I know that in Chicago, I can't make any money. Back then, when I bought that deal, properties were ranging about $110,000 a door. So this was just, the market's really going up. So apartments were about $100,000 to $110,000 a door because all these converters were buying these apartments and they were converting them, making them condos. And so everything was very expensive. So I said, okay, we need to pick a different market. So I started to look at the Indianapolis market, the Cincinnati market, and started to see the fundamentals in those markets that I could make more money. I could pay less for a property, be all in at a less cost than what it would cost me to buy those deals, and rent them at more money and make a higher return on my investment. So we put together a buying strategy which consisted of 65% or greater 2-bedroom or greater apartments. So I wanted 2 and 3 bedrooms. I'm not a 1-bedroom buyer. I wanted garden style C plus to B plus product. Back then, you couldn't buy an A class product because the people that were buying A class back then were your insurance companies, your hedge funds, and they were buying those products to clip a coupon because they'd have people invest and they had to keep their investors satisfied. Today, cap rates are so compressed that the pricing between B and A runs so close that you might as well just buy an A-class property today. So that was part of the buying strategy, C plus to B plus product. We looked at up to 150 units. I never thought I could buy a 200 unit apartment complex, but all of a sudden I'm buying 350 and 450 unit complexes because we scaled so fast. So 2005, I did the first deal. I went out and I raised $18 million. I bought $60 million worth of real estate with 4,000 apartments in 5 markets. And I did that in 30 months. So I grew very fast, very unstable as a company. I thought I had a team of people behind me that were stabilizing product and nobody was stabilizing anything. So it was, when you buy a property, you should spend the time to make sure that your construction's underway, your rehabs are underway. You should make time to make sure that you are starting to re-tenant that property, change the demographics, make sure your curb appeal's done before you go on to the next one. I see too many people grow way too fast, and the instability that causes in a company structure can cause us to falter. And that's one of the big takeaways I have from my history. I also vertically integrated a property management company where we were managing 7,500 units. So within that 30-month period, I grew a company that was pretty close to $100 million in value. 2008 rolled around and it was like hitting a brick wall in a freight train at 200 miles an hour. I was unstable. The company started to unravel and fall apart, and I didn't really know how bad it was going to be. I actually was sitting at lunch with my CFO one day, and we're watching the news, and it was just kind of a fluke thing. We went somewhere, the news was on, and we were watching people carry boxes out of Lehman Brothers. And if anybody remembers 2008, but we were watching people carry boxes out of Lehman Brothers by the droves. And I looked across the table at him and I said, "We're screwed, aren't we?" He said, "Yeah, we're in big trouble." And I don't know that I understood the depth of that comment at that point. But over the next few months, we just watched the world unravel. We had Lehman Brothers that went out. We had AIG that turned upside down. We had Goldman Sachs that had problems. And we had a lot of syndicators that just fell apart and came off the rails. I had 12 or 15 deals. I had 38 companies, but I had 12 or 15 of them that I should have just let go to foreclosure and let those investors get hurt. But if you remember at the beginning, I said, I was a hero. I wasn't the kind of guy that wanted to give anybody bad news. I didn't want to tell anybody anything was wrong. So I thought I could fix everything. So I went to my accountant and my attorney, and I came up with a plan that I could move money between companies. I could take money from profitable organizations, profitably running companies, move it to non-profitable companies, try and right the ship, and keep everybody safe and keep everybody afloat. Well, that was fine. But what I didn't do was I didn't disclose to my investors the movement of money. So for non-disclosure of that movement of money, I wound up being charged on wire fraud and mail fraud charges and got sentenced to 10 years in federal prison. So in 2013, my entire life turned upside down. I wound up in court being sentenced to 10 years in prison and got shuffled off and went away to federal prison camp. Aaron, do you want to unpack anything at this point, or you want me to keep going?
Yeah, I want to ask a couple questions and then
Yep.
that have you definitely dig in with that one. Okay, so looking back at that, and you talk about you didn't tell your investors, what would you have done differently? Would you, looking back now, would you have to say, look, guys, look, we're gonna go under with this, or will you have done the same things? I know you didn't want to really hurt nobody's feelings or anything like that, but would you have done it differently now? I think everybody can say, I've done this differently, but what's the thing, what's the biggest thing you would have done differently now than what you did before?
Great question. Five mistakes I made. One was I grew too fast. I was very unstable as a company. So there was no stability. So when the market started to unwind, our occupancies dropped, our NOI dropped. We were undercapitalized. Second problem. So I didn't raise enough money. Here's what else I did. If anybody knows the syndication business, they know in a PPM that there's language in a PPM and a private placement memorandum that says, hey, if there's a problem, Aaron, I'm going to come back to you as an investor and ask you for capital to put more money in the deal. Well, I took that provision out of my PPM. The markets were scaling at such a high rate. I thought, well, you know what? These markets aren't going to fall. I'm never going to need this from my investors. One of the complaints investors say is that my sponsor comes back to me and asks me for money. I didn't want to be that guy. I took it out. I raised money like crazy. As a result, that was one of the reasons that we were able to raise money so much. Well, so here I am, unstable as a company, undercapitalized, and I'm over leveraged. Now, write this down, guys. Never buy property where you are 80 to 85% loan to value. Everything I owned, I was 80 to 85% LTV. It was crazy. I had $60 million worth of real estate at 85% loan to value. You knew, I don't know who was worse, me for taking the money or the banks for giving it to me at that point, because you should be 65 to 75%. Today we're underwriting deals. We're underwriting deals today at 65%. This market's going to change right now. I see shades of 2007, 2008 right now. So there's the first three mistakes. The fourth mistake was I didn't pay attention to the details. I thought I had a team of people that were doing things behind me like they should have been, and I wasn't paying attention to the KPIs, those key performance indicators, like I should have been. And so I didn't see the detail. And then the fifth thing was I didn't listen to the people that were in my closest circle of influence, including my wife and my closest attorney and accountants, that told me, I don't like what's going on. I don't trust the people around you right now. You need to take another look at this. And so, Aaron, to answer your question, all five of those things are different today in my life. I'm resyndicating deals again. And all five of those things don't exist in my life today. They're quite the opposite. And what I would have done different was I would have let those 15 deals go to foreclosure and let those 25 or 30 investors get hurt instead of trying to save everybody and right the ship.
Right. Just to let you guys know, I'm going to open up for questions in a little bit. Just want to ask Mike a couple more questions. So I'll stop right there, Mike. You can finish on what you were saying.
Okay.
I just want to ask that one question right there.
Yeah. So perfect. So I went to prison in 2013, and here's what I always tell people. I say, look, I never flew private. I didn't have a big house. I didn't have a boat. I didn't buy a fancy car. I was the neighborhood baseball coach. I had a great marriage. I was home every night for dinner. My wife and I were best friends. And I got ripped from that to live in a 12 by 12 room with three men I didn't know, nor did I like. I had three green outfits, five pairs of cardboard underpants, and I was wondering what the hell happened in my life. And I walked around for the next 3 weeks wondering that. How am I going to get through today, much less 10 years of this mess? I was in prison about 17 days, and my wife decided she was going to divorce me, and it wrecked me. And all the way to the door, I thought, well, I should divorce you, and we'll get through this. We're going to be fine. Well, that wasn't the case. I went to prison. She divorced me, and the joke in prison for the first year was we should take his shoelaces because we think he's going to hurt himself. Um, so I was probably in prison about 6 weeks. And, think about a time in your life when you've had a defining moment. I think we all have defining moments in our life, and we get those lessons or a message. Well, I had this defining moment in my life. I'm gone about 6 weeks, and I walk in the gym one day, and I pre-qualify this with everybody because I was only window shopping. I didn't walk in the gym to buy anything that day. I wasn't looking to work out. I wasn't looking to change my life. But this guy walks up to me and he goes, "Hey, look, um, don't let these people beat you. All they want to do is take everything from you. They can take your business, they can take your money, they can take your real estate, they can destroy your family. But what they can't take is who you are. They can't take what you're made of and what got you to build that $100 million company, what got you to build that construction company before that. They can't take any of that from you. They can't take your brains." He said, "Look, come to the gym every day, start working out." I'd gone from running marathons to being 35 pounds overweight and hating myself. He said, "Come to the gym every day, start working out. You'll start to feel better, lose weight." I said, and I don't know what it was, really. I mean, it was just like somebody flipped the switch, and I went, okay. And I started going to the gym. I started working out. I started to lose a few pounds and feeling better. I wound up going to college. I went to college for 4 years. I got a bachelor's degree in theology. I wrote two books while I was gone. One is called Exit Plan: Your Complete Guide to Multifamily Investing and Why You Need an Exit Plan Before You Buy. I wrote a book on property management. I wrote an ethics study course, and I taught real estate investing, property management, and ethics in prison for 6 years. How ironic, a federal inmate teaching ethics, right? Um, I was on an outreach program. I would go into the community and tell my story. I told my story 40 times to local business owners and local college students. I met a professor from the University of Minnesota, and he and I co-authored a paper that we had published last year in the Business Journal of Ethics that gets taught at the collegiate level for forensic accounting and sales and marketing classes. Today, I'm in the coaching and training business. I teach people how to scale their business and hopefully live a balanced lifestyle, how to grow their business successfully and do more, but really pay attention to the things that are important in their life and that mean a lot to them. Um, I also just recently was approved by the SEC to go back and be an issuer and a sponsor of deals. So actively just closed our first apartment deal in Tampa, actively raising capital for other apartment deals. And, life is turning around. There's still a lot of broken things, but, there's things that, it's the redemption. I always tell people, I say, I have this great success. I lost everything. And today I'm on that road to redemption. And, I feel that I want to tell the world my story because I believe that we can't be defined by our past. We all have stuff that's happened to us and things that have happened in our lives. And, I was telling Aaron earlier that I was gone with a bunch of guys that just laid down and died. And I wasn't about to let that happen. I think that my story provides that hope and that inspiration. Listen, I don't know that there's anybody on this call that hasn't been affected somewhere in their life by somebody going to prison, by drug addiction, by divorce, by sickness, by death, by brokenness, and you can't let that stuff define you. Move forward, take the next step. They say if you grow 1% a day, that you grow 365% a year. What's it take to grow 1%? One more phone call a day, one more contact a day. So, I want people to understand that there's more to life than what has happened to you. So, um, today I'm back in the business. I wrote the book Exit Plan. I'd love everybody to grab a copy. You can go to my website. I put the information in the chat. But I wrote that book because over the years I spent hundreds of thousands of dollars going to coaching and training and seminars, and everybody, really great trainers, really great teachers. Everybody teaches you how to find a deal, buy a deal, operate a deal. Nobody teaches you how to get out. Nobody teaches you how to maximize. And that's what I wanted people to understand is how to get out of a deal. Exiting doesn't always mean that you're selling it, you're liquidating it, you're getting out. There's other ways to exit a deal. So yeah, absolutely grab a copy of that. I have a ton of free resources on my website. You can grab those too. So,
I just want to say this to you, Mike, and we said this earlier. I just want to say thank you for sharing your story. As we said before, some people don't want to share their story. Some people are afraid to share their story. And like you said, this can save lives. It can save people's businesses right here. Just sharing the story and you telling from the time that you started to a low point to now where you're going back to being stable and inspiring people. I think in my mind, that you're more credible than ever now because you know the pitfalls. So you can tell people, hey, listen, this is what happened to me. You don't avoid these things. And I think that's really going to have people know, like, and trust you even more because of those things. I think I just want to say thank you, not only for this meetup, being on this meetup guest speaker, but this also for you sharing your story. I heard your story before on another podcast, and that really inspired me right there. So just want to say thank you.
Yeah, absolutely. And Aaron, I'm a huge networker, and anybody can call anytime. I'm accessible, and email me, DM me. I'm all over social media. If you have questions, if you are looking for guidance, don't hesitate to reach out. What's up, Angel?
So look, I want to hold your time. So I'm going to open up for attendees right now and let them ask you questions. I know it's been a long day for you. Definitely want to, I want you to be here longer than you have to. So I definitely want to open up for attendees to ask you questions, starting with my overseas. Well, I'm gonna start with Cedric and then my overseas investor. So go ahead, Cedric.
All right, Aaron, thank you. And Mike, thank you again for your story. So my question is, when you was moving the money in between companies, I think you said that you had spoken with your attorney about it. So why didn't the attorney advise you that that's not legal or unethical or whatever it's called?
Because it's a great question, Cedric, but it's not illegal. Okay, so the action of moving money between companies is not illegal. Matter of fact, my accountant and my attorney both told me that if you have a paper trail and you put the money back, here was my thought around it. My thought was, hey, I've been involved in recessions in the past. A typical recession lasts 17 or 18 months. There's a 10 or 12% correction in the market. And so we got a few months left in this thing. I'll move the money. I'll put the money back. Now I'll be a hero. I'll go tell everybody this is what we did. What was illegal was that I didn't disclose it to my investors. Disclosure and transparency is a huge thing. Actually, 5 years before I was indicted, the SEC would have fined me $250,000, slapped me on the hand, said, go back and fix your business and don't let it happen again. Today, they destroy you. They put you out of business. So it's a big difference today. And and I don't throw anybody under the bus, right? I broke the law. I didn't tell my investors. I take full responsibility for that, and I feel awful for it. And I've even talked to some of my past investors since I've been home. But um, the uh, the fact is that when different political parties come into play, different laws change, things change. So along the way, things have changed, which caused it to be worse. Now the feds just put you out of business. They don't even let you try to regroup it or straighten things out, which is kind of a shame because listen, I was in prison with a lot of people, men and women, that were that had problems and issues similar to what I did, and shouldn't be in jail. So
Thank you.
Hi, my name is Claudia. I just want to say thank you for being here, and your story is so powerful. Thank you for sharing. You mentioned something about like working with the team and things that I guess did you trusted them or they somehow let you down. So I am a long distance investor, so I work remotely and I have a team boots on the ground in my market. And so, that always scares me, like working with people and like trusting that they're doing right by you and that, right, like they're out there working on your behalf. And what advice do you give for like having, trying to set up that team the best as possible to minimize any like, issues or problems in your experience? Thank you.
yeah, great question. Really great question. So I had over 100 people working for me. Some were boots on the ground on properties. Some were in my office. We had property management. We had, not only did we manage our own 4,000 units, but we managed another 3,500 for other owners. I had a partner who was really good at his past career. We had been friends for 25 years. We knew each other a long time. He was really good at an operations guy in his old career, which was different than what we were doing. I thought that the skills were transferable, so I didn't pay attention, right? The skills weren't transferable. And he got in over his head, and I didn't pay enough attention, my fault again, to the key performance indicators. Make sure you know what you need to look at. Okay. If there's construction work going on, make sure you know what those stages are that need to be done, that you're getting pictures, you're getting video, you're doing walkthroughs from a distance. We do a lot of rehab from a distance. Make sure that, this is a powerful tool today, the iPhone, right? And the iPad, and you can do a lot of things with it, and you don't have to be somewhere else. Just make sure you know what your key performance indicators are and that you're paying attention to them. If there's discrepancies month after month, week after week, quarter after quarter, there's a problem. So back then, a decade ago, when I was syndicating deals, we did everything ourselves. So we did it all in-house. Today, what's interesting about the business is we put teams together. So I just did an apartment deal. I partnered with two of my coaching clients. And what's really interesting is you find people who are better than you are at certain things. Hey, I am not a detail-oriented person. I like to build relationships. I'm a visionary. I like to see the big picture. I like to paint a picture of what it's going to look like tomorrow, but I hate reading documents. And I get to the third page on a 40-page PPM and I'm asleep and I got to start over again tomorrow. So I got a partner who's really good at that. Okay. And she reads all the documents and she comes to us with questions and then, And then I got another partner who's really good at buying construction material and granularly working with the contractors. And I'm really good at other stuff. So find out who you're good with, what you're good at, what are your strengths, what are your weaknesses, what's your partner's strength and weaknesses, and how do you put partnerships together today that complement each other. So hopefully that helps somewhat.
Does anybody have any more questions? I have a question for you, Mike.
Yeah.
Once again, thank you for sharing your story. We talked at length before about the whole thing, and it's inspiring, very inspiring story, really inspiring, right? So what have you seen the changes from before in 2008 and all that to what changes do you see now? You said things about the turnaround. What change do you see that has transformed the real estate space right now?
So there's a super, we've got a super high inflation in that, and I don't mean inflation. There's a super high residential pricing going on right now. Houses are more expensive than they've ever been, and that was one of the things that was happening back then. I don't think that we will see as bad of a fall as we saw in 2008 this time, because I think the government won't let it happen. They know to watch for it. They'll pump more money into the economy. They'll raise the interest rates. They'll cause that inflationary piece to happen, which will put a Band-Aid on the situation. But you've got housing prices that are really high. You've got cap rates that are compressed. I'm underwriting deals today at 2%. Are you kidding? A year ago, I said they can't go much lower than 5%. And here I am, at half of that today, underwriting deals in Florida. And I'm like, this is crazy. I talked to a broker today. I just closed on a deal that we bought for $116,000 a door. He's got a deal that's coming to market next week. Same submarket that we bought this other deal in for $170 a door. Same product type. So there's this propped up pricing value in the marketplace today. You've got P&Es in the stock market that don't make sense. You got, cryptocurrency that who knows where that money's at. And I'm not saying any of it's bad. I'm just saying watch it. And I'm not saying don't invest in real estate, because there's always 2 times to plant a tree, right? 20 years ago and today. So, it's gonna go up. It'll value out. Rents are gonna go up. Just watch the markets that you're going into, and watch what the fundamentals in those markets are. Today, I look at a high population growth market, which creates a high rent, which creates so population goes up, jobs go up, rent goes up. Those are 3 of the major metrics to look at in a market before you underwrite a property. So does that help, Lawrence?
Thank you. It does. Thank you.
Yeah, you bet.
Go ahead, Cedric.
Yeah, Mike, can you tell a little bit more about your book, the one the exit strategies book?
So there's a bunch of stories in it, a bunch of examples of exiting deals, of buying deals. It's very fundamental. It's a how-to. So I walk you through strategy in it. And it's, like I said, I talk about different ways to exit a deal, which are, Cedric, you don't just have to sell out to get out, but you can recapitalize, you can bring a partner in. I brought a partner in a deal, and I talk about it in the book. I brought a partner into a deal that we owned for about 9 months, And the partner I brought in was an institutional investor, a life insurance company. And we took our private investors out of the deal. They all made money. Everybody made money. But, we exited the deal and stayed in the deal. So what you want to look at in structuring an exit plan is where you're going to get out and maximize your revenue, maximize your capital. Hey, if I can make profit twice on a deal or 3 times on a deal, why not try and do it? So typically when you underwrite, or when I underwrite, I have a spread that shows me 10-year vision, right? From 0 to 10 years. And somewhere in that 10 years is my highest profit point. And then it tends to go back down or levels off. Why not capitalize on that? Pull your profit out, now redo your deal, and you'll see it again that it's profitable somewhere else down the road again. So you might as well ride the wave and stay in, hold on to that deal. You just need to underwrite differently today. The other part about exit is there's a lot of fundamentals along the way. What's your capital improvements going to be? What's your financing going to be? Can you refinance somewhere along the way? So there's a number of things to look at, and I talk about all those in the book. But you could just go to my website at mycoreintentions.com/exit plan and download a book there. Or if you're like me and you like to read, you can, go to Amazon and buy a copy of the book. And I like books because I highlight them, I dog ear the pages, I put sticky notes on them, I go back, so.
One last question concerning your book. Man, I can't think of the app. Where it reads to you. Is it on Audible?
Yeah, no. Sorry. Yeah.
Look, I'm like you, Mike. I do like the book. I like the book, having it, like you say, so you could dog ear it, but it's just the reading part, man. But awesome. But you know what? I will be getting the book. I'll definitely be getting the hardcore book because I agree with you. A lot of people tell you how to buy the property, but I don't really know any that tells you how to exit the property.
Yeah.
So awesome.
And like I said, 3 pages into a 40-page PPM and I'm asleep. So I get it.
Okay, you just said something that struck me, Mike.
Uh-huh.
You said that you had to underwrite differently nowadays. What do you mean by that?
Okay, so I'm underwriting different today than I have in the past. I'm looking at properties differently. I'm being, everybody throws the word out there, conservative, but what does it mean to be conservative? What do you back that up with? So my conservativeness today, I'm underwriting my deals at 65% loan to value. Okay. That's one of the first metrics. I'm putting 50 basis points on what a lender is quoting me today on the interest rate. So if a lender's quoting me 3.75, I'm underwriting that deal at 4.25 because I know it's going to change by the time I lock it in and get to closing. So I want to look at that view today. If that broker's telling me I can raise those rents $100, I'm going to do my own due diligence. I'm going to figure out what I come up with. I'm going to take the broker's rent comps and I'm going to go get 3 to 5 of my own. And my analyst is going to put that data together. And I'm probably going to be about 75% of what that number looks like. So if that comes out and it's a $200 a month rent increase, I'm only going to raise those rents $150 year one after my CapEx. Cost of material is a moving target today. So what I might have figured a square foot before for rehabbing an apartment, I'm probably going to add some to that. I'm going to look at my taxes differently today. I'm going to, increase my taxes because those are going to go up and they're probably going to go up more. And then my moving forward, Hey, listen, I'm underwriting deals in Florida where the rent growth in the last year has been 12 to 15% in the submarket we're in. Well, is that going to be true moving forward? Probably not. So if I underwrite my deal today at 5, year 1, and then year 2 I go to, so if I when I underwrite those rents, if that first rent increase is, call it, you know, $150 a unit, that could be a 10% rent increase that year 1. Well, then year 2, I'm going to go to 5% and then 4%, and then I'm going to balance out at 3%. My cap rates, my terminal cap rates, here's how I'm figuring them today. If I'm buying a deal today at a 3.5 cap, I'm going to figure by the time the market changes, and I believe that the market's going to change just prior to the election in 24. We'll see the market really start to shift mid-year. I don't think that the Democrats are going to allow the market to fall now because they don't want to go to the election platform with any independents or any Republicans saying, look, they wrecked the housing market. So they're going to keep that propped up. But I think we're going to get to somewhere around September or August. And this is kind of where I'm drawing my line in the sand. September of August of 24, we're going to start to see the housing market start to fall out, inflation come up. The pricing is going to change across the board. So if I'm buying a deal today to 3.5 cap, I figure it's probably going to be south of 3% when we get to the election point. If I'm holding a deal for 7 years, let's say I'm at 3% at 24. Now I'm going to go another 4 years. I figure my cap rates are going to come back up about 25 basis points a year. So I'm back to maybe a 4, maybe north of a 4 on my terminal cap rate when I go to sell out of that deal. So I'm just, I don't know that math is right. I don't know that it's true, but on everybody I've talked to, and I'm not an economist, but I'll tell you, there's a couple of people in the marketplace I really like. One is the CEO of Marcus and Millichap, and the other is the economist at Walker Dunlop. I think what they really talk some serious truth about what it is. Hey, listen, everybody's seen the Christmas Carol, right? The 3 ghosts, the ghost of the past, the ghost of the present, and the ghost of the future. I really believe that we're in a space right now. You need to be looking at the ghosts, because look at the ghost of the past from 2007 and 8. Look at where we're at right now. We're in this accelerated market, which reflects the ghost of the past. It's only going to show that the ghost of the future, to be safe, you got to be really, really fundamentally secure in what you're talking about.
Thank you, Mike. That was pretty eye-opening right there. The ghost of the past, the ghost of the future. Go ahead, Kevin.
Hey, Mike. With respect to the approach that you just laid out with your underwriting, how successful are you in having deals accepted? Or another way is like, how far off of the asking price are you with that approach?
Yeah, I'm north of the asking price, pretty much on it, almost pretty much every time we're buying a deal. And Kevin, I underwrote 100 deals to write 7 LOIs, to be the bridesmaid 6 times, to finally get to the altar once. So I say that because you have to, you got to be willing to put the work in. I bet we've underwritten another, if my analyst was on the phone, he'd probably say somewhere around 75 deals again this second round, trying to find the next deal. I had 2 deals recently that I got to the final and best round on, and we pulled the plug. we decided we weren't going to move forward with them because on one of the deals there were some mechanicals that I couldn't get my key principal to come to the table on, and I couldn't really get my arms around thinking that I don't like chillers, and in Texas there's a lot of chillers, and so this one deal had a chiller, and I thought I'm not going to do this and aluminum wiring and kind of be the high bidder in the deal, so it didn't make sense. So we walked on it, and then there was another one here in Chicago that we could have won and would have been a great coupon at maybe 6% a year, preferred return. But I wanted to see if there was anything that would have been stronger than that. So you got to underwrite a bunch of deals. It's a lot of work. It's going to take a lot of time. You're going to get paid a lot less on that deal you win on because of all the work you put in on the underwriting of the other ones. So it just is what it is right now. Your option is to change asset classes, right? Get out of the multifamily space, make more room for us, and go do something else. You didn't like that idea, Kevin? I mean, there are other asset classes, right? We're looking at self-storage a little bit. And I've heard a lot of people talking about industrial right now, that the cap rates in industrial are different. The profit point is different. And they see that ghost of the future is a little bit different. So I haven't looked in that space at all, but I know some guys that have left multifamily to go to the industrial route. So.
Go ahead, Cedric.
All right, Mike. So you were mentioning right now pretty much everything that you put an offer on, you're going north of the asking price. Now, are you doing that only because of the current state of the market? Were you doing that back, say, 15 years ago when you were really into the market?
No. 10, 12 years ago, 15 years ago, when we were buying deals, we knew we could buy a deal at 20% off of asking price. 18 to 20% off asking price, we were buying everything at back then. And I was heavy in the Dallas market. Matter of fact, here's a funny story for you. So in my book, I talk about a deal in Dallas that I did. And I had a guy read the book on a red eye one night from coming back to New York from California. He called me from the airport. He said, hey, and it's like 7:00 in the morning. I see my phone ring and I answered. I go, God, you're calling early. He goes, I have to ask you. He goes, did you really buy that deal at a 13 cap? I said, yeah. He goes, what's it trading at today? Well, somebody we all know just bought the deal, and they bought it at a 5 cap. Same deal in Dallas. And so, pricing changes. Everything changes. So.
All right, thanks.
Yeah.
Anyone else with a question? There you go. Bam.
What's for dinner?
Banana right now.
Wow. Thanks, Aaron. Appreciate it. You go ahead.
Thanks, Mr. National. Claudia, did you ask your question?
Oh, yes, thank you. I did.
Okay. All right. I make sure my overseas
Great presentation.
And you guys check your email too, Claudia. Send your email. But Mike, if anybody has more questions, man, I just want to say thank you once again. Just sharing your story and being so inspirational. And where can everybody find you at?
Yeah, great question. Like I said, I love the network. I love to chat. So if I can answer any questions or do anything for people, don't hesitate to reach out. You can find me on social media, anywhere you hang out or get your social media fix. You'll find me either Mike Morawski or My Core Intentions. And, you know, I love Instagram lately. So Instagram, LinkedIn, and YouTube. Go like me, love me, subscribe, would you please? I could appreciate the following. And then if you want to just reach out to me, either DM me on Instagram or my email is mike@mycoreintentions.com. So
Cool.
I have a couple. I was just going to say, Aaron, I have a couple other things that we just put up on the website too. That if you go to mycoreintentions.com/free, I have a couple more ebooks there. One's on passive investing, and one is on I want to say that it's it's called multifamily fundamentals. So
Okay. Cool. Cool. We got one more question. One final question. Cinto, please ask your question.
Hey, good evening, everyone. Mike, thanks so much for your time and your value add in your story. It's really inspiring. Just real quick, where are you? You look familiar for some reason. Where are you based out of?
I'm in Chicago.
Oh, no kidding. Do you know? Okay, I think me and a friend have talked to you before. That's why the prison story sounds familiar. Do you know a Garnett Roy? Do you know RJ? They invest in multifamily. The meetups there.
Yeah, I know RJ. I'm friends with Ben Cashman.
Oh, you look so familiar! Holy cow! Yeah. So
I wish I could say you look familiar too.
I'm no, I'm on LinkedIn. You look familiar. Okay. I was like, wait, this sounds familiar. So okay, yeah, I just had to confirm. I was texting my partner. He's like, who are you meeting up with? I'm like, oh, this is Mike Morawski. Yeah. He's like, dude, we talked to him. Okay, well, I'm glad you're in Chicago. Stay warm or stay cool. Either way. But I look forward to meeting you in person. That's awesome. Thanks, Mike.
Yeah, you bet. Thank you.
Cool. Okay. So just to let you guys know before we end this recording, next week will be Christine Leah. She's a CPA and she's really going to tell you some good steps about taxes for this year. So since you're doing your taxes, so she'll be the guest speaker next week. Thank you, everyone, and see you guys later.
Thanks, Aaron.